Hey folks, it's Simon here. Welcome to Tao Daily for Wednesday, the 26th of February, 2025. Another week a day on the markets on Tuesday. The S&P losing 0.5%, Nasdaq losing 1.25%. And what we are lacking here in the market are really nice, strong trends to trade. Now, what we do have is plenty of high volatility and uncertainty. So what this means is just taking smaller position sizes. Risk management always comes first, and we really need to be cognizant of the fact that there are very few strong trends to trade. And as a result of that, we want to be really mindful about how much risk we put on until stronger trends emerge. Now, a lot of this uncertainty, we talked about this a couple of days ago, is stemming from economic uncertainty. You can see this is the US Economic Policy Uncertainty Index, and that has spiked. Previous spikes occurred during the COVID crisis, during the global financial crisis, particularly around the Lehman bankruptcy, and during 9/11. All right, so that is what's driving a lot of the uncertainty and volatility. And to be honest with you, the market so far has barely reacted. You look at the S&P on a monthly chart, doesn't look like anything has happened. You look at it on a daily chart, yeah, we've certainly got some sideways chop here. And I would think a retest to the bottom of this range is certainly likely. Now, where are the trends? Where are the trends in play that we can trade? Well, one thing we can look at is which sectors are performing. So if we look at month-to-date performance, there are only 5 sectors that are positive so far for the month of February. They are consumer staples, very defensive sector; real estate, very defensive sector; energy, it's a bit of a wild card; utilities, very defensive sector; and healthcare, which has got strong defensive characteristics. These are the sectors that are attracting institutional money, all right, because they are outperforming. If we look at something like XLP, consumer staples, this has had a massive performance and it's been up strongly even as the overall market has been really weak. What happens when big money gets concerned about the economic outlook? They don't just sell stocks wholesale, all right, because they destroy the market. What they do is they employ sector rotation. So they'll move money from kind of high growth, more opportunistic, more optimistic sectors like consumer discretionary or tech, and move it into more defensive sectors like consumer staples and utilities. Now, we may get to a point where the economic weakness just becomes unavoidable, and then we do start to see wholesale selling, and that's what causes a bear market. But right now what we're seeing is sector rotation out of more growthy-orientated sectors into much more defensive sectors. We've also got a key macro risk event today in NVIDIA. We've got NVIDIA earnings. Now, we talked about this on our members' call yesterday. If NVIDIA earnings can kind of blow the market out of the water and we see NVIDIA up 7% post-earnings, that sector rotation we've seen into defensives could stop and reverse very quickly, as optimism towards tech and AI would be buoyed, at least in the short term. The technicals on NVIDIA are ugly. This gap fill reversal, we talked about it a couple of days ago, it was really nasty. And NVIDIA earnings today, Wednesday after market, are looming as a key macro risk event. That's what I got for you today, folks. I hope it helps, and I'll catch you next time. Thank you.